Imagine two friends, Sarah and Jamal. Both earn the same salary, save diligently, and want to invest. Sarah chooses index funds. Jamal goes with ETFs. Fast forward 10 years. Jamal's portfolio is up 40% more than Sarah's. Why? It's not luck, it's strategy. In this video, we'll uncover the key differences between index funds and ETFs, the pros and cons of each, and which one might be the smarter choice for you. Stick around, because by the end, you'll know exactly how to invest like Jamal and avoid the common traps that held Sarah back. An index fund is a type of mutual fund designed to mirror the performance of a specific market index, like the S&P 500. Instead of trying to beat the market, it simply matches it. That means lower fees, less active management, and more predictability. You buy in, and your money is spread across hundreds of companies. It's like owning a slice of the entire market. But here's the catch. You can only trade once a day, and minimum investments can be high. So while it's simple and stable, it's not always flexible. An ETF, or exchange-traded fund, is like an index fund with superpowers. It also tracks a market index, but you can trade it like a stock. Want to buy at 10 a.m. and sell at 2 p.m.? You can. ETFs offer real-time pricing, lower expense ratios, and more tax efficiency. They're perfect for investors who want control and flexibility. But beware. With great power comes great temptation. The ability to trade anytime can lead to impulsive decisions. Still, for many, ETFs are the modern way to invest passively, with precision. Let's break it down. Index funds are priced once daily, at the market close. ETFs? They're priced in real time. Index funds often require a minimum investment, sometimes $1,000 or more. ETFs. You can start with the price of a single share. Index funds are great for retirement accounts and long-term investing. ETFs shine in brokerage accounts and tactical strategies. So if you want simplicity, go index. If you want flexibility, go ETF. But there's more to consider, especially when it comes to taxes and fees. Here's where ETFs often win. Their expense ratios can be as low as 0.03%, while index funds might hover around 0.18% to 0.50%. That difference adds up over time. Plus, ETFs use a clever mechanism called in-kind redemption that helps avoid capital gains taxes. Index funds, not so much. They're more likely to distribute gains, which means Uncle Sam gets a cut. So if you're looking to minimize taxes and maximize returns, ETFs might be your best bet. But remember, fees aren't everything. Your behavior matters too. Not all ETFs are passive. Some are actively managed, meaning a team of experts picks the investments. These ETFs aim to beat the market, not just match it. They come with higher fees, but offer more strategy. Think of them as a hybrid between traditional mutual funds and passive ETFs. If you believe in expert insight and want to try something more tactical, actively managed ETFs could be worth exploring. Just make sure the performance justifies the cost. Many people think ETFs are risky because they're traded like stocks. But that's not true. Most ETFs are diversified and track broad indexes. Others believe index funds are outdated, but they're still a solid choice for hands-off investors. Another myth? That you need a lot of money to start. In reality, ETFs make investing accessible to almost anyone. The key is understanding your goals and choosing the tool that fits. Don't let myths hold you back from building wealth. Let's look at a real ETF, VOO, which tracks the S&P 500. It has an expense ratio of just 0.03%, trades like a stock, and holds the same companies as many index funds. It's tax efficient, easy to buy, and perfect for long-term growth. Compare that to a typical index fund with a 0.2% fee and limited trading. Over 20 years, that difference could mean thousands of dollars. So when choosing, look at the fact sheet. Fees, holdings, performance. It's your financial blueprint. If you're a beginner who wants simplicity and stability, index funds are a great starting point. If you're more hands-on and want flexibility, ETFs offer more control. Want to avoid taxes and fees? ETFs win again. But if you're investing through a retirement plan, index funds might be your only option. The truth is, there's no one-size-fits-all answer. The best choice depends on your strategy, goals, and personality. So ask yourself, do you want to set it and forget it, or do you want to steer the ship? Sarah and Jamal started the same, but Jamal understood the power of ETFs, the flexibility, the tax advantages, the lower fees. Sarah stuck with index funds and did fine, but Jamal's portfolio soared. Now it's your turn. Whether you choose index funds or ETFs, the key is to start. Don't wait for the perfect moment. Don't get lost in analysis. Just begin. Because the best investment isn't in the market, it's in your future. Like, subscribe, and let's build wealth together, one smart decision at a time.